Good morning. Welcome to you all. As Rhonda said, unfortunately, the head of our branch, Anastasia, she would have loved to have been here, but unfortunately, she's away. She's in Brazil at the G20 gathering. But my colleague Nicolas and I will be presenting this year's edition of the Trade and Development Report. But before we do that, I thought it would be useful to give some context to the publication. The Trade and Development Report, or TDR, as we refer to it, is one of UNCTAD's main flagship publications. It was actually first published in 1981, at a time when a severe and prolonged debt crisis was about to hit the developing countries and ultimately led to what is considered a lost decade for much of the developing world. Now, at that time and through the years up to today, the TDR has served as UNCTAD's principal vehicle for assessing the evolving global economic situation and particularly its consequences and ramifications for developing countries. Now, rather than taking a short-term approach to the developments in the global economy, we instead look to place current and emerging economic trends within a longer-term systemic and structural context. In this way, we link developments at the national level with structural and cyclical components of the global economy. And this is why the TDR has always emphasized the importance of the external environment in the economic outcomes observed specifically in developing economies. The originality of the report through the years lies in its discussion of national policies and strategies in the context of the performance of the global economy. Now, turning to this year's TDR, as I'm sure you know, we launched this year's edition about 3 weeks ago. The publication has 5 chapters. I'm going to present the first chapter, which covers the global economic outlook, where we outline the main macroeconomic trends that we have identified that are affecting the global economy this year and next year. And then afterwards, my colleague Nicolas, he's going to look more specifically at the evolution in international markets. So we can say that we have seen some turbulent years for the global economy of late. We had the pandemic shock in 2020, which resulted in a severe contraction of the global economy that year. We then saw a fairly robust recovery in 2021. But then again, at the beginning of 2022, we had the shock from the outbreak of the conflict in Ukraine. Now that the dust has settled, so to speak, on these shocks, we're able to get a clearer picture of global growth trajectories. So what are we seeing? Well, on the positive side, we can say that we have seen inflation, which spiked and reached its peak in 2022, mid-2022, across the globe, has gradually descended and now lies either within or very close to central banks' target ranges for inflation across the globe. At the same time, when we look at the different developing regions across the world, we do see several countries which continue to expand and to grow at brisk or in even some cases accelerated pace. And lastly, the turbulence we saw in financial markets in August of this year have been for the most part contained. We didn't see the kind of financial contagion that many feared at that time. So we can say we do see some positive notes. However, those positive notes cannot mask the fact that what we're seeing in this post-pandemic period is a new normal emerging of depressed global growth rates. If we look here at figure 1, what we have, the blue charts we have here is the annual growth rate of the global economy. And we take more of a long-term view here. We can see that prior to the global financial crisis of 2008-2009, global growth was at a fairly brisk pace at 4.4%. Then we had the global financial crisis, and in the aftermath of that crisis, we saw a significant downshift in global growth, down to 3%. Now, unfortunately, this was not a transitory or temporary phenomenon. At the time, that was what was argued. However, as we can see here, that downshift in growth persisted all the way through to the run-up and, in fact, to the outbreak of the pandemic in late 2020. Now, in the aftermath of the pandemic, what are we seeing? We're seeing a further downgrading, a further downshift in global growth, now down to 2.7%. When we look at this, it's key to remember that the growth performance we were seeing prior to the pandemic was far from spectacular. It was already an unsatisfactory level of growth, and what we're seeing now is a further downgrade in that growth rate. In the report itself, we go into much greater detail regarding the different regions, the economic performance and outlook as we see it of the different regions of the global economy, and we also analyze the larger countries in each of those regions. But just here to give a snapshot, what we're looking at is the three largest economic blocks of the global economy. And what we see, broadly speaking, is stagnation in the United States and European Union, and we see a gradual deceleration of the Chinese economy. If we first look at the chart here on China, we can see that over the last 20 years, we have seen a gradual deceleration in the growth rate of the Chinese economy. Now, much has been made of this deceleration. However, our view here is that it is neither surprising nor is it concerning in of itself to see this deceleration. It is normal and to be expected that an economy like China, as it goes through its different development phases, sees a certain degree of slowdown in its growth rate. So in of itself, we do not see this as surprising nor concerning. What is, however, potentially somewhat concerning is that when we look at the Chinese economy and we look at the principal drivers of growth of the Chinese economy over the last 2 to 3 decades, there has been to a large degree the property sector and the export sector. And we look now at the situation, first looking at the property sector. We've seen that the real estate and construction sector in China has been contracting since 2021 and continues to do so. Now, this has become a priority area for authorities in the country, and they have enacted a series of different measures to stabilize the sector. However, as of yet, they have not been entirely successful in doing so. But more importantly, looking forward, it is somewhat challenging to see that property sector continuing to provide the same kind of growth impetus that it has done in the past. And similarly, when we look at the export sector for China, in the past it has been one of the pillars of the growth of the Chinese economy. However, when we look at recent trends, we see that there's increasing numbers of measures being adopted by some of the largest trading partners of China, specifically targeting the manufactured goods coming from China. And in this context, it is again somewhat challenging. We're seeing a more challenging context, I would say, going forward, to the extent to which the export sector can continue providing that same contribution to growth. Now, if we move on to the European Union, what we see again in the case of the European Union is stagnation. While it's true that for this year and for next year, we are estimating a slight improvement in the growth rate, it's important to remember that this comes from a very low base, and it continues to be a very subdued level of growth we're seeing for the European Union as a whole. Now, unfortunately, in the case of the EU, subdued growth is not a novelty. It's been an issue which the bloc has been dealing with for several years now. However, since the pandemic, we have seen particularly weak growth in the European Union. There are a number of factors behind this, but just to highlight one particular topic is that of the German economy, which has in the past been one of the main drivers of growth of the EU. And if we look since the pandemic, we've seen particularly weak performance from the German economy. In fact, last year it registered a contraction. For this year, we're estimating a slight improvement, but again, to register more or less flat growth. Next year, we're estimating another improvement, but again, it still remains very low growth rates. Now, what's behind these developments? In the specific case of Germany, what we see is there's both external factors and domestic factors at play. On the external front, what we see is the country has been particularly hard hit by disruptions to energy provision to the country. At the same time, many of the sectors in which the German export sector was particularly dominant, in recent years we're seeing increasing competition from other players in those sectors. And finally, if we look at the domestic side, we can see there have been largely self-imposed fiscal rules that have severely limited the government's ability to use fiscal policy to stimulate growth of the economy. And finally, we turn to the United States. Now, while it is true that the US economy has been the strongest performing of the large advanced economies since the pandemic, for next year we are estimating a significant slowdown in growth in the US to 1.8%. And what's behind that? What we're seeing is a cooling labor market, which is basically a deceleration in the rate of employment generation, and that is affecting, or is going to increasingly affect, consumption spending, bringing that consumption spending down. And also, when we look at the policy stances, what we're seeing is a tightening of fiscal policy in the United States. And although I'll go into more details regarding this, the following issue, just to mention that monetary policy also, while we are seeing the beginning of the loosening of monetary policy, of a reduction in interest rates, it's very important to remember that this is just the beginning of monetary loosening, and interest rates, both domestically in the US and internationally, remain at relatively high rates. Now, if we look now more specifically at the Global South, at the global growth, at the growth performance of the Global South, again, we see a similar story to that for the global economy. What we see here on the left is the contribution to the growth of the Global South by the different developing regions. On the left, what we have is from the period 2003 to 2013, and on the right, what we have is from 2014 to 2024. Now, much like the global economy as a whole, what we're seeing is a significant deceleration in growth rates between those two periods. We went from 6.6% growth overall for the Global South during the first period to 4.1% over the last decade. Now, as we can see, with the contributions from the different developing regions, a large part of this is to do with the deceleration, as I explained earlier, in the Chinese economy. However, it is by no means simply a result of that evolution of growth rates in China. If we look, in fact, all the developing regions between these two periods have seen a significant reduction in their growth rates and in their contribution to growth overall of the Global South. And in fact, if we actually take China out and look at the Global South excluding China, the situation is actually far more concerning. In that case, what we see is growth rate going from 5.1% in the first period to just 2.8% on average, an average annual growth rate of 2.8% over the last decade. Now, to be perfectly blunt and direct, 2.8% is simply an insufficient growth rate to begin for the countries of the Global South to begin to be able to address the economic, social, developmental, and climate challenges that they now face. Now, in this section of the Trade and Development Report, we highlight two key issues which we believe are affecting the global economic outlook. The first is the issue of debt. Now, what we see since the pandemic is a broad and significant increase in public debt levels, and this is consistent and widespread across the globe. Here, what we see in the chart on the left is for developing regions. The light blue chart shows the level of public debt as a percentage of GDP. The light blue line is the level in 2019. The darker blue line is the level in 2023. And as we can see, there's a significant increase for developing economies as a whole in their public debt levels, going from 55% just before the pandemic to almost 70% today. And as I said, this is consistent across the different developing regions. In fact, most significantly, when we look at developing Asia, we've seen an almost 20 percentage point jump in the level of public debt, from just under 60% to almost 80%. But similarly, in Latin America and the Caribbean, we also see a jump of 7 percentage points to just under 75%. And in sub-Saharan Africa, we also see a 10 percentage point jump to 60%. Now, what does this mean? What do these increases in debt levels actually mean? And why are they significant critically? Well, it means that these countries are having to dedicate ever greater proportion of their public resources to servicing this debt. That is, to making the payments on the interest and principal payments on this debt. If we just look across the globe, we're seeing cases in both Africa and Asia where governments are dedicating approximately 60% of their public budget to servicing their debt obligations. And these are critical resources that are being diverted away from much needed spending on goods and services that are needed. This spending is needed to address problems of poverty and income inequality, but also it is depleting the resources available for public investment spending, which are critical in meeting both development challenges and increasingly climate challenges. And to this end, and again, I'll go into more detail in a little bit, the increase in interest rates we have seen as a result of the tightening of monetary policy has made that the burden of this of debt servicing costs has increased significantly and has compounded the challenges associated with these higher debt burdens. So the critical question here is what to do about this situation, what to do about these increased levels of debt burdens and of debt servicing costs. And here, from our perspective, what we see as being particularly concerning is that we are seeing a return of fiscal austerity as a policy prescription. Now, fiscal austerity does nothing to resolve. In fact, it worsens the shortfall in public spending on goods and services that is needed to address poverty and income inequality. And also, very importantly here, when we see these kinds of austerity packages or spending cut programs being implemented, they invariably fall disproportionately on public investment spending. Now, why is this? It's simply because it's often much more politically palatable to make cuts to public investment spending, since the very short-term effects tend to be less severe. And while it is true that the short-term effects are less severe, such cuts in public investment spending have profound and long-lasting detrimental impact on the development prospects of developing countries. And this is a detrimental impact which is very hard to reverse going forward. So in past TDRs, and again in this year's TDR, we look to shift the focus onto public revenues to ensure that fiscal revenues adequately and appropriately reflect the economic and financial gains, particularly reaped by larger corporations and top earners. Just as an example, between 2015 and 2019, we saw that around 40% of multinational profits were shifted to tax havens. And this has meant that there was a reduction of around 10% in global tax revenues. And the countries most affected by these practices are developing countries, particularly in Africa and Latin America, where these countries lose a far larger share of their total tax revenue compared to wealthier nations. So as Anastasia mentioned in her opening remarks, what we see is a very important step in the right direction is the establishing earlier this year of the United Nations Framework Convention on International Tax Cooperation. Now, just very quickly, the main purpose of this convention framework is to promote a more inclusive global tax cooperation under the United Nations umbrella, and it particularly highlights issues of equitable taxation rights, exchange of information, the need for all countries to work together to eliminate tax evasion, tax base erosion, and profit shifting, and to ensure that all taxpayers, especially multinational corporations and transnational companies, pay taxes to the governments of countries where economic activities actually occur and where the revenues are actually generated. And crucially, the UN Convention framework seeks to give a greater voice to developing countries in determining global tax arrangements. Now, in this section of the report, we actually highlight an issue which we refer to as pleasant and unpleasant fiscal arithmetic. As I said, the rise in public debt after the COVID-19 shock raised the usual concerns about government solvency worldwide, with different calls for action depending on the economy under analysis. In developing economies, there have been recommendations for fast and sharp fiscal consolidation measures in an effort to gain policy credibility, and even if that requires a significant slowdown or even contraction in GDP growth. While on the other hand, when we look at advanced economies, what we see is they have been able to adopt much more gradualistic approaches and are able to tolerate larger fiscal deficits, particularly fiscal primary deficits, for a more extended period of time. Now, why this disparity between what developed and developing economies are able to do in terms of their fiscal situation? Here, in practice, the challenge lies in reducing the cost of public debt in developing countries. And this is closely linked to what economists refer to as R minus G, R being the real interest rate and G being the real growth rate of the economy. And it's the difference between these two rates which is critical and where we seek divergences between developing and developed economies. In the long run, recent evidence shows that the real interest rate is lower than GDP growth rate in most advanced economies. And this creates what we call a pleasant fiscal arithmetic. It means that a country can grow out of its high debt ratios while at the same time maintaining moderate fiscal deficits, primary fiscal deficits. However, on the other side, what we see in most developing economies is the opposite. That R minus G is highly positive, meaning that the real interest rate the governments pay on their debt is much higher, or is often higher, than their growth rate. So in this context, to be able to keep public debt under control, these countries have to run large fiscal primary surpluses. And given that developing countries need more public spending on universal public services and on infrastructure, that constraint on fiscal balances is restraining, and it's largely incompatible with making progress towards development goals. So in this regard, in addition to the necessary domestic actions, in order to address this unpleasant fiscal arithmetic that most developing economies face, what we propose are two responses at the global level. The first entails a coordinated increase in taxation on cross-border activities, and that's especially on high net worth individuals and large corporations, in order to raise government fiscal revenue and improve the fiscal balances in developing economies. And the second involves a multilateral initiative to reduce the risk premia on selected government investments in developing countries. And to do this, proper policy coordination and international support are both key. Now, the second key issue which we flag with regards to the economic outlook is that of discontent or dissatisfaction with the post-pandemic prevailing economic status quo. Now, what's behind this discontent or dissatisfaction that we are seeing? And I should say this is a widespread feeling of discontent which we see both across developed and developing economies. The first key issue here is that of inflation, of consumer prices more specifically. Now, we saw inflation peak in mid-2022, and it is true that we have seen a gradual deceleration in inflation rates since then. However, in terms of consumer prices, the level of consumer prices, what we see for both developing and developed economies is that consumer prices remain significantly above the levels which we would have envisaged or expected according to the pre-pandemic trend. Obviously, this changes somewhat depending on the country, but on average, what we see is consumer prices at between 10 to 15% above the levels we would have expected, given the pre-pandemic trend, both in advanced and developing economies. And this is eating. The critical issue here is that these higher prices are eating into households' disposable income. And this is reflected in what we're seeing here. Now, what we have here is, on the chart, what we have is the real per capita household consumption spending in a number of different countries. The light blue line, it's an index, so it reflects the level of that spending in the third quarter of 2019, just before the pandemic hit. And the darker blue line shows the level in the first quarter of this year. And what we see here is in several countries, we see stagnation, but in a number of countries, we also see, in fact, a decline in that consumption spending today compared to just before the pandemic. And this is also, the consumption spending has recovered over the last 2 to 3 years, but it is still below the levels that many households were able to spend prior to the pandemic. And as I said, this fuels this feeling of economic insecurity, which is a key factor driving the widespread dissatisfaction with the prevailing state of affairs. People are seeing that the prices of the basic goods and services that they buy every day are still much higher than they were just a few years ago. And on top of this, again, I keep coming back to this, and I will go into more details regarding it. Another key issue here is the tightening in monetary policy, which we saw as the very severe and prolonged tightening in monetary policy that we saw in reaction to the increase in inflation rates. And this has meant that interest rates have gone up across both developing and developed economies. So again, consumers go out, and when they try to take out a loan, say to buy a car, or even on their credit card bills that they pay each month, they see those interest rates have gone up by very significant amounts. And again, this is fueling those feelings of economic insecurity and a growing feeling of dissatisfaction and unfairness with the prevailing economic state of affairs. And this is an issue which I've mentioned quite a few times, but here I'd like to go into a bit more detail regarding it. And that has been the reaction to the policy response to the increase in inflation rates. What we've seen is, broadly speaking, an over-reliance on monetary policy as pretty much the sole policy tool to bring inflation rates back down to central bank target ranges. Now, given that there were various factors behind the increase in inflation that we saw immediately after the pandemic, when we saw the global economy's near paralysis in 2020 and the fairly robust recovery in 2021, this resulted in significant supply bottlenecks across value chains across the globe. And along with this, we saw shifting consumption patterns. Also, we saw a surge in commodity prices, and compounded to that, we have increasing market concentration and market dominance, particularly in certain sectors. So given that there were a variety of factors that were fueling that increase in inflation rates, by relying almost exclusively on monetary policy to address the increase in inflation rates, this resulted in excessive and prolonged monetary tightening. And this has caused undue hardship across the globe in terms of restricting economic activity, in terms of increasing the financing costs for households, for firms, and for governments, for exacerbating financial instability risks, and particularly with regards to developing countries, these policy responses have resulted in increasing depreciationary pressure on their currencies, and also, as I mentioned earlier, on amplifying the debt burdens that the governments in these countries face. And those increases, those severe increases in interest rates that we saw in advanced economies, what developing economies then saw was an obligation to largely match those increases and also tighten, monetary policy in their own countries domestically. Now, while that could be understandable at a time when inflation rates in those countries were high, what we have seen over the last few months is that in a number of developing countries, based on the domestic inflationary fundamentals, they would normally be able to have loosened their domestic monetary policies quite a bit by now. But given the fact that in the advanced economies, there was a huge delay and we continue to see broadly tight monetary policies in those advanced economies, this has meant that in developing countries, they have had to also keep their monetary policies tight, despite the fact that under the domestic factors, they should have been able to loosen and reduce interest rates by now. Now, why is that? Why do developing countries see the need to keep their monetary policy tight? This is because as long as in the developed economies we see tight monetary policy and higher interest rates, a lot of times developing economies see that if they loosen their monetary policy, if they cut their interest rates, that will lead to the emergence of a differential, of a difference between their internal interest rates and those interest rates internationally. And such differentials in the past, and again there is the risk going forward, that if those differentials emerge and are significant, what developing countries often see is large-scale outflows of capital from their economies, which in of itself has severe problems, but that also leads to much more severe depreciationary pressure on their local currencies. So again, they seem to have to keep their monetary policies tight, and that has the detrimental impact, as I mentioned, on economic activity and on financing costs within their economies. Now, a second issue which we see is key in fueling this feeling of discontent and unfairness with the global economic situation is that of income inequality. What we've seen since the pandemic is, broadly speaking, an increase in income inequality levels. And again, this is a widespread phenomenon which we're seeing across the globe. What we have here now in these charts is the labor share of income. So just to explain very quickly, when we have the total value addition in an economy, this is distributed to labor in the form of wages, it can be distributed to companies in the form of profits, and it can also go to rents and to taxes. And what we have seen, this is both since the pandemic, but it is also a longer term trend, is a decline in the share of income that goes to labor. We can see a number of countries here, and as I said, this is a widespread trend that we have seen, and it is a long-term trend that we are seeing. Now, although you will see in these graphs, there was a temporary spike in the labor share just when the pandemic hit. Now, at that time, we argued that the increase in the labor share during the pandemic was a temporary phenomenon due to the relatively larger fall in profits compared to wages in that particular context. And data on the post-pandemic period has confirmed those expectations, and we have seen since the pandemic that the labor share of income has continued to decline. And without concerted actions, there's little to suggest that this trend will be reversed going forward. And this has negative consequences for both the global economy and for income inequality. So this data gives us a broad snapshot of what is happening in labor income or for labor income as a whole. However, with data on the distribution of income, that is data that shows the distribution of labor income amongst the different levels or strata of income earners, we're able to get a better idea of how that income is being distributed within labor. And here, what we have on the chart here is the darker blue line shows that proportion of labor income which goes to the bottom 50% of income earners. The yellow line shows that which goes to the top 10%, and the gray line shows the the proportion of income that goes to the very top 1%. And again, there are certain issues with data here in terms of things. Just for 1 second. Thanks. What we see here, again, this data has certain limitations in terms of availability. It's available with a lag usually of 2 years, and in terms of country coverage. But with the data we do have, we are able to get a snapshot of what is happening, and we have data available now for 2021, 2022, so we can see what has happened in the post-pandemic period. And what we see is that the share of labor income going to that bottom 50% has gone down since the pandemic, and the share of income that has gone to the top 10%, and specifically to the top 10%, to the top 1%, sorry, has increased significantly since the pandemic. And this means that that those at the lower end of the income spectrum are bearing the brunt of the overall downturn in labor income that we saw in the previous graph. So in view of these issues and these trends that we have identified, in the Trade and Development Report this year, we present a series of policy proposals to address these issues and to broadly steer the global economy onto a more dynamic, resilient, inclusive and sustainable path. So the first area of policy action which we highlight is that of fiscal revenues. The public debt buildup, as I mentioned, in the aftermath of the pandemic, as well as the size of investments needed to address prevailing development and climate challenges, make it clear that rebalancing state budgets requires greater revenues. And the path ahead calls for a coordinated move on global taxation, particularly on high net worth individuals and large corporations. And to that end, what we propose is a coordinated clamping down on corporate arbitrage practices, tax havens, and conduit jurisdictions. We also call for multilateral mechanisms to redress any asymmetries in negotiating positions of developing countries vis-a-vis developed countries. And lastly, as I mentioned, the establishing earlier this year of the UN Framework Convention on International Tax Cooperation, we see as a very timely and important step in the right direction. A second key area of policy action is to do with improving the access to affordable, reliable, and long-term financing options. And this is in order to secure adequate public investments towards development goals, particularly for the most vulnerable developing countries. To this end, priority policy actions on the international sphere include increased concessional finance through the capitalization of multilateral and regional banks, the issuance of new and the reallocation of existing special drawing rights of the IMF, the utilization of innovative financial instruments such as sustainable development bonds and resilience bonds, and finally the expansion of currency swap facilities. A third area is to do with the policy tools to tackle inflation. As I said, monetary tightening has been costly as a major factor in restricting economic activity, in increasing financing costs for households, firms, and governments, also in exacerbating financial instability risks, and particularly for developing countries, in putting greater pressure on domestic currencies and on debt burdens. So in this regard, a more balanced policy mix, addressing the different forces driving inflationary pressures, would on one side be more effective, and it would also entail less undue hardship. This policy mix would include concerted actions to rein in anti-competitive practices, abuses of dominant market positions and corporate concentration, particularly in key sectors. This would include price stabilization tools and revisions to the existing regulatory framework for commodity trading activities. And this is needed to curb what we see as excessive excessive financial speculation. And finally, to put a stronger focus on monetary policy, on financial stability and liquidity management in the financial system. Now, closely linked to this last point is that of the fact that monetary authorities, we stress monetary authorities, should consider the wider impacts of their decisions. And among the factors to consider are the impacts of those monetary decisions on debt trajectories and servicing costs, on the financing of critically needed investments and financial stability. And it's important to say here that those kind of changes cannot be ad hoc. There are changes in the criteria and functioning of monetary policy making that need to be embedded in the mandates of monetary institutions. Now, to address the issue of rising income inequality, we see reversing the trends of a diminishing labor share and a rising income inequality need to be a policy priority in both developed and developing countries alike. And these need to be addressed through more equitable policy solutions. This includes concrete commitments to more comprehensive social protection as a necessary starting point. We also see systemic policy measures to help lower inequalities and deliver more inclusive growth, and these need to be essential components of development and growth strategies. And finally, we highlight the importance of industrial policies. Now, what we have seen in recent years, particularly since the pandemic, is a return, an explicit and clear return of industrial policies to the agenda of developed economies. However, despite that, the industrial policies do to a large degree are still frowned upon as a policy tool in developing countries. And the argument behind this is based on the assumption that the risks of industrial policy outweigh the benefits when a country does not have the appropriate institutional framework in place. However, what we argue here is that when we look to the past and where we have seen successful development cases, it indicates that the sequencing is in fact the opposite, where industrial policies inevitably create risks. However, they also induce improvements in governance structures and regulatory frameworks, and these improvements in turn increase the success rate of industrial policy. Now, why do we argue that industrial policy is so critical? It's because industrial policy is needed because markets alone cannot deliver the required structural changes and structural diversification that is required to achieve progress on development. My colleague Nicolas will go into more detail regarding this, but in today's context, new industrial policies need to be adaptive to external constraints. They need to be broadened to encompass all economic sectors, including services. And internationally, this requires greater policy coordination, and an effective and functioning multinational framework and mechanism has a key role to play in ensuring this policy coordination. So with that, I'll end, and I'll now pass over to my colleague Nicolas, who will go through the main trends in international markets.